Well, good afternoon, ladies and gentlemen, and thank you for joining us here today for another OIC-sponsored webinar presentation. My name is Ken Keating, and I'm an Associate Principal here at OCC Investor Education, as well as an Options Industry Council instructor. And I will be giving today's presentation on understanding options pricing. So just to give you a quick background on myself, before coming to OCC, I was a professional trader for well over 25 years. I started out as a floor market maker on the Pacific Coast Stock Exchange in the early 90s. I moved to Chicago where I traded on the CBOE. I was a floor trader as well as a floor specialist. I moved upstairs where I ran off-floor risk management desks. I ran off-floor prop trading desks. I managed money for myself as a remote market maker, and I spent many, many years as an equities and derivatives analyst. So currently I work at OCC helping individual investors such as yourselves to both better understand the risks and the benefits of exchange-traded options. So getting into the disclaimer here, we always have to mention our disclaimer. Options do involve risks and are rather complex vehicles. So anybody who's looking to trade options should read and understand the characteristics and risks of standardized options. Now, you can obtain a digital copy at optionseducation.org, or for a physical copy, you can contact your broker or any exchange on which options are traded. So options are rather complex vehicles, so anybody who's looking to trade these should fully understand the product and before trading them in a live account. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. All right, a little bit about the OIC. Who exactly is the OIC? Well, the OIC, we are the Options Industry Council. We are the education arm of our parent company, the OCC. The OCC is the Options Clearing Corporation, which is the world's largest equity derivatives clearinghouse for exchange-listed options, as well as the Foundation for Secure Markets in the United States. So we started out as a cooperative in 1992 to better educate the public on both the risks and benefits of exchange-listed options, and we do that primarily through our website, optionseducation.org. There you'll find online courses, podcasts, videos, as well as webinars, and we can provide you this information free of charge. So we do this because we are fully funded by the OCC, so we have no hidden agenda. We're not looking to upsell you on subscriptions or tiers of service. We just want you to be better educated about the product and hopefully making good decisions and making a lot of money along the way. So just know that we are not registered advisors. We cannot talk to you about specific stocks, setups, where you should be investing in the options market, what are the best strategies for this given period of time. But we can talk to you about options theory, options strategy, or how corporate action may affect your options position. Now, the pride and joy of the OIC is our investor services desk, which can be reached at options@theocc.com with any and all of your options-related questions. So this, once again, is a free service, and I strongly recommend that anybody who has questions regarding options can send us an email, and the turnaround on responses is usually pretty quick. So we have a very deep bench of knowledgeable people on our team. We probably have well over 100 years of trading and brokerage experience within our group. So certainly a wealth of knowledge that you can tap free of charge. All right, here is today's presentation outline. So first, we're going to be talking about supply and demand. So as we're talking about options pricing, we're going to be looking at supply and demand. Then we're going to be looking at pricing models. We're going to then delve into implied volatility, which is probably the most important aspect when it comes to trading options. So that's something that I hold near and dear, and it's something that I always tell people is the most crucial aspect, but most misunderstood part of trading options is understanding implied volatility. So we'll get into implied volatility. Then we'll look at moneyness of options. So options can be either in the money, at the money, or out of the money, what that means. And then lastly, we'll look at intrinsic and extrinsic value. So Q&A will be conducted along the way. My colleague, Matt Cashman, is behind the scenes answering all your questions in real time. So if you have a question, just pop out the Q&A box at the bottom of your screen and ask a question. Now, one of the more frequently asked questions that we get is, can I view this webinar in the future? And the quick answer is yes. All of our webinar presentations are recorded and archived. So if there's if you want to just rewatch the webinar, if you missed some of the terms or want to go over some of the concepts, certainly you can use the same link to access this webinar at any point in the future. Also, you can download a copy of the PDF of the event by going up to the Resources List tab and downloading a copy of the PowerPoint deck that I'm presenting here right now. All right, so now let's get into it. Option pricing basics. So let's get into option pricing. So option pricing. Who makes all these option prices? So when I pull up on my brokerage platform, I pull up a stock and I pull up an options chain and I see calls and puts and various strikes and various prices and flashing red and green colors. Who's making all these prices? Well, there's no one answer for that. Basically, the options prices that you're seeing at any given time are the collective market for anybody who is making a market in that particular product. So it could be individual investors, it could be hedge funds, pension funds, banks, it could be professional market makers like I used to be, making a two-sided market in a product. So what you see, the market that you see for any given product is what's called the NBBO, or National Best Bid, Best Offer. So let's just say that a stock is trading $50, and we look at an option, say it's a March 50 call, and the market on that option is $3 bid at $3.20. So, and it's 200 up. And what that means is that there's 200 contracts bid for on the bid at 3, and there's 200 contracts on the offer at 320. So that the market's telling me that I can sell 200 contracts at 3, and at the same time I can buy 200 contracts at 320. Now, 310, which is the midpoint, is what traders would call fair value. So the midpoint of that bid-ask spread is what's called fair value. So just to put you in the mind of a market maker, what I used to do. So a market maker comes up with what they feel is a fair value for an option, and then they make a market around that option. So if I think that market is, the 310 is a fair value market, I'm willing to buy it for 3, but at the same time I can sell it for 320. So whether I buy the option or sell the option, I'm theoretically making 10 cents. So, and then I'm hedging it with stock and options and everything else. But over time, that called theoretical edge. Over time, whether I'm, all day I'm buying on my bid, selling my offer, I'm compiling this mountain of theoretical edge, which in theory, over time, should come in, and that would be my profitability. It doesn't always happen, but in theory, that's what should happen. So, but in the end, what's an option ultimately worth? Well, an option is only really worth what somebody is willing to pay for it. So option pricing models, we use them as guidelines and tools, but in the end, overriding factors will influence theoretical values, and those factors being the factors of supply and demand. So going back to the example that I was using, what if the market's 3 bid at 320, 200 up, but then all of a sudden the large buyer comes in and wants to buy 5,000 contracts? Well, there's only 200 contracts on the offer. That's going to push the price higher. So they're going to buy 200 for 320. They're probably going to buy some at 325, 330, all the way up to 350. Maybe he gets filled at 350. So now 350 is the new fair value, and the new market is 340 bid at 360. So, and maybe the stock is just unchanged. It hasn't moved. So, but what has changed? Well, implied volatility due to supply and demand has gone up. So the stock hasn't done anything, but that option is worth from a fair value standpoint, 40 cents more than it was 10 seconds ago. Okay, and this is what's happening in the options market. Anytime you see these prices, those prices are just a snapshot of the supply and demand for those options at any given time. So just to refresh some Econ 101, so in a simple sense, supply and demand, when we have high demand equated with low supply, we are going to get higher prices. So in this case, we have 1 barrel of apples, and we have a bunch of people that really want apples, and those apples are now trading for $1 a piece. And so when we have high demand and low supply, we're naturally going to get higher prices. And you see this in the economy today. So with the supply chain issues that we saw due to COVID, you saw the price of meat go higher, the price of toilet paper, the price of cheese, eggs, you name it. The chips that go into cars. Cars are basically four-wheel computers now, and there was a chip shortage, so the price of cars went higher. And because the price of new cars went higher, the price of used cars went higher. So it's all demand chasing low supply. We're going to get naturally higher prices. On the flip side, when we have high supply and low demand, we're naturally going to get lower prices. So all of a sudden, apples are trading for $1, and you get a bunch of producers that say, well, God, if apples are trading for $1, I'll just produce more and make more money for myself. So as more and more producers produce apples and there's a higher and higher supply, well, now there's more supply than there is demand. And because of that, the natural forces will force prices down. So now apples that were once trading for $1 are now trading for 50 cents. And it's no different in the options market. It's all based on supply and demand for options, whether option prices are high or option prices are low. All right, so now let's look at pricing models. So what are pricing models? Well, essentially pricing models are formulas that can be used to you basically take all these inputs that go into an options model, you put it in the model, and the model is going to crunch out what are option values or theoretical values. And those models are only going to generate values based on the inputs that you put into them. So supply changes in supply and demand will also determine changes in implied volatility, which will affect the value of those options. So we'll see that in a bit. But option models can remove the emotion from the pricing. Now, models aren't going to make your investment decisions for you, but simply they're a tool to allow you to monitor and evaluate options prices. So options prices are subject to many unforeseen variables, and supply and demand is one of the most unpredictable. So one of the trading firms that I worked for many, many years, the partners used to have a saying, and it was a 3-word saying, and that saying was, price is everything. And those 3 words resonated with me as a trader, because when you think about it, and you're trading options, price does mean everything. Price will make you, and price will break you. And how do you measure prices? By analyzing implied volatility. So we'll get into that in a little bit. But pricing, when you're trading options, pricing is everything. So pricing models. Once again, I talked about the inputs. There's 6 inputs that go into a pricing model. So you have the stock price, the strike price, the volatility, the implied volatility, time to expiration, and the cost of money, interest rates less any dividends. And when you put that all into a theoretical model, what you're going to get are theoretical values, or option call and put premiums. Now, as you can see, these inputs, most of these inputs are pretty fixed. So at any given time, we know what the stock price is going to be. We know what the strike price is going to be. We know how much time there is till expiration. Interest rates we pretty much know, and the dividends. The wild card in this is volatility. So traders are always trying to solve for implied volatility. So one way to solve for implied volatility is you can take the price that you see in the options market and back solve for whatever implied volatility will be. You can use an options calculator to do that. I'll show you how to do that in a bit. But so basically, what is implied volatility? Well, implied volatility is essentially the volatility level that justifies a given premium amount that you see in the options market. And the models that we're using are really only as good as the inputs that you put into them. So, like the old saying goes, garbage in, garbage out. If you put in bad inputs, you're going to get bad outputs. So, and once again, volatility is the one component that all option traders are trying to solve for. All right, so 1973 was a particularly interesting year for the options market. Well, options started trading in 1973 on the Chicago Board of Options Exchange. But prior to 1973, there wasn't really a formula used to quantify from a mathematical perspective what an option could or should be worth. But then along came Fisher Black and Myron Shoals, these two gentlemen here, and they published what is known as the Black-Scholes pricing model. And this model really revolutionized how to price options. So for those of you who are more math-oriented, here's the formula right here. Now, I consider myself pretty decent in math, but when you start throwing in letters instead of numbers and coefficients and all these brackets and it's just this just makes my head spin as well. But this is the formula, and this did revolutionize options pricing. Now, just know that this model, while revolutionary at the time, did have its limitations. Now, the limitations were that this model did a good job at modeling European-style options. In other words, options that expire or can only be exercised on expiration. So these days, the type of options that are European-style options are usually the big indexes, or the SPX options on the S&P 500, the Russell, the NDX, the big cash-settled indexes are European-style options. But for the most part, the majority of exchange-listed options are American-style options, okay? And American-style options can be exercised at any time for any reason on or before expiration. So it didn't take into account early exercise very well. So it didn't take into account early exercise or dividends. It held that volatility was constant. We know that volatility is always changing. It held that short-term interest rates are constant. We know that interest rates do change. And this was what is known as a log normal model. So what does that mean? Well, a log normal model, basically, the Black-Scholes model did a good job at pricing options at expiration, but not such a good job at pricing all the time intervals before expiration, okay? And so this was a log normal model. And some of the additional limitations were that commissions or transaction costs, there were none. We know that that's not the case, that there are transaction costs, and that the markets are efficient. Well, we know that the markets at times are not efficient. So for a while, this was the only model that we had. And then along comes, in 1979, the CoxsWAS model. And this model was an extension of Black-Scholes. And this model did factor in early exercise, where the Black-Scholes model didn't. So this model does a better job at modeling American-style options. Okay, accounted for early exercise and dividends. So this model was considered what is known as a binomial model. So essentially what a binomial model does is it takes the end price at expiration and works backwards. In other words, it breaks down time into many intervals between now and expiration. So on any given day in the future, you simply don't know what the volatility may be on that given day. The binomial model takes today's stock price and assumes that it can go either higher or lower, okay? So now you can have the model and know the formula and have your inputs and crunch these numbers and do it all manually, or you can take the easy route and use an options calculator. So most brokers on their trading platforms have options calculators. Now we, at OIC have a free one that you can use if you go to our website, and you can find it under the Options, Quotes, and Calculators section on our website. But this is a snapshot of the calculator right here. So it's pretty self-explanatory. If you need some help with it, you can actually go to, in the upper right, there's where it says Calculators Help. You can click that, and a syllabus will pop out, and it'll explain all these different boxes here. But essentially what you do is you put in the symbol for whatever stock you want to look at, you hit go, and it's going to populate the all this data on the left. So what it does, by default, it's going to take the near-term, at-the-money call and put and give you a theoretical value. So if you wanted something other than the near-term at-the-money call, if you're modeling an in-the-money call, that's 3 months out, or an out-of-the-money call, you basically change the parameters on the left. So in this case, we took a stock that's trading 100. We wanted to model the 100 strike, 49 days to expiration at a 20% volatility. We will get into more about volatility in a bit, but a 20% volatility and a 2.1% interest rate. So when you put all that into the calculator and you hit calculate, you get what are known as theoretical values. So based on all the data that I punched into this calculator on the left, we have a theoretical value for our call of $3.06 and a theoretical value of the put, which is $2.80. So if I looked at my options chain and I could see that the market was, say, 290 bid at 320, well, I'd say my calculator is pretty much calculating fair value at 306. That's about right. And, these options are trading about a 20 volatility, okay? But what if I pull up my options calculator? I put all this information in, but I pull up my options chain, and I see this option is really trading $3.50. Okay, well, then I have to ask myself, well, my calculator says the option is worth 306, but why is the option trading for 350? Well, what's off on one of my inputs in my calculator? Some of my inputs have to be off. Well, if everything is right, if I know the stock price, the strike price, days to expiration, the wild card, once again, is volatility. So because the option is trading for a higher price than 306 in the actual market, my volatility assumption is probably too low. Now, I can't do this on the calculator, but I can't do this on the screen right now, and I've already done this. But you can use the calculator in a different way as well. You can actually put in this lower right-hand box where it says call and percentage volatility, you can put in an options price. So if you put in 350 and hit calculate, it'll give you a volatility number. And actually the volatility number is 23. So with the stock trading 100, the strike trading, the 100 strike, 49 days to expiration, at a 23% volatility, fair value on the call is going to be 350. So, just different ways to use the calculator. And I'll tell you, it is one of the more popular tools on our website. And you can certainly use this calculator to to model some what-if scenarios. Maybe you put on an options position and you say, oh, God, well, what happens if the stock goes up by $10 and volatility goes down 3 points? And you can put all these parameters in and, figure out what a fair value for that option is. Or, instead of 49 days, what's this option worth in 2 weeks with the stock up $5 and volatility unchanged? So there's a lot of what-if scenarios that you can play around with. So I strongly suggest that you go to the website and play around with the calculator. And like I said, it's one of the more popular tools that we have on our website, and it's free of charge. All right, so now let's get into implied volatility. So, and I always tell people this, and if you've heard me give these talks before, I could talk for 2 hours plus just on implied volatility. And it really is the most misunderstood but crucial aspect of trading options. So if you want to trade options and you want to trade them profitably, which I know you all do, because why else would we be trading options unless we're trying to make money? But implied volatility is the most misunderstood but crucial aspect of understanding options. So what exactly is implied volatility? Well, it's the volatility assumption at which the option is currently priced in the market. Okay, so we can arrive at this through a pricing model, okay, And volatility is the input resulting in the value, which is the same as the current market price. So, once again, that the volatility that we're seeing is it's what the market is anticipating. So volatility is a forward-looking measurement. It's trying to anticipate how volatile our stock is going to be between now and its expiration, and it's doing that through the options. And once again, how are option prices moving? Well, they're moving because of the collective bids and offers within the options market due to supply and demand, and it's composed of, all kinds of participants, both professional and individuals such as yourself. So, volatility is constantly moving. It's always changing. All right, so one thing to talk about, an easy way to think about implied volatility is, so implied volatility, when you hear traders talk about implied volatility, now they have shows on these financial networks where they're doing whole shows just on options. And you hear traders talking about volatility or vol. So when traders talk about volatility or vol, all they're really talking about is the level of options prices. So when volatility is high or vol is high, options prices are high or expensive. And when volatility is low, option prices are cheap or inexpensive. And when I was on a trading floor and trading, and we're doing trades all day and talking about them and commiserating and whatnot, traders would never talk and say, well, I bought these December options for $3 and I sold these January options for $1. No, we would say something like, I bought a 25 vol in Dec and I sold a 35 in Jan. Okay, so it was a way for us to measure volatility. It's a way to talk about the pricing level of the options, and you do that through implied volatility. So this chart here, there's two types of volatility. There's historical volatility and implied volatility. Now, historical volatility is backward-looking and measures how volatile a stock has been sometime in the past. So this black line that you're seeing, think about it as an EKG for the stock. So this is how volatile a stock has been in the past. Now, the orange line is the stocks or the options implied volatility. Now, only options have implied volatility. And once again, the implied volatility is trying to, of the options are trying to price how volatile a stock will be between now and its expiration. So implied volatility is forward-looking. Historical volatility is backward-looking. It only applies to the stock itself. So now the implied volatility for the options can be a great variance with the stock's historical volatility. So just because a stock has been erratic in the past doesn't mean it's going to be erratic in the future. It may be, it may not be. You just don't know. So predicting the stock's future volatility, it might be right, it might be wrong. You just don't know. Just because the stock has been quiet in the past doesn't mean it's not going to be volatile in the future. So implied volatility, the changes can occur. They can occur intraday. They can occur over time. They can occur abruptly and significantly. Right now, as you can see, if you're watching the markets, we're into earnings season, and as companies are about to report, so people are all they're posturing and positioning for earnings announcements, and typically stocks are a little more volatile into earnings, okay, because the market's trying to measure how much that stock is going to move, either up or down, based on what the company's going to report for earnings. So implied volatility, or the price of options, will tend to go higher into earnings, trying to compensate for, because usually there's a higher demand for options. People are buying calls because they think the stock's going to go up. They're buying puts because they're hedging in case the stock goes down. There's a higher demand for options, so the prices go up. So this, just because the implied volatility doesn't go up, the stock can just be unchanged. The stock price doesn't have to move at all for the implied volatility to go up. Let's just say that there's a stock, the biotech stock, and all of a sudden they're about to present an FDA trial in 3 months, and the stock is either going to be down 75% or up 50% based on this news. Okay, so that's a binary event, and the implied volatility in the options will measure. You'll see what the market's reflection of what it expects for that particular issue, and it's the most dynamic feature of any options premium is the implied volatility. Okay, so implied volatility, will it return to its stock's historic volatility level? So in other words, if a stock has been pretty quiet in the past and the implied volatility for the options is high, will it revert back to its long-term historical volatility? Well, it may and it may not. Okay, there's no guarantee that just because the stock has been quiet in the past and the implied volatility is high, that you can make money selling it. Over time, in theory, yes, volatility is somewhat mean reverting, meaning that let's just say that we're looking at a volatility chart. And when I was a trader, I was constantly looking at volatility charts all day. I was looking at 1-year charts, 2-year charts, 5-year charts, near-term charts, trying to get a feel for different time periods. We actually have a free 1-year volatility chart on our website that you can play around with as well. But let's just say that over a year, the stocks had a range of 25 volatility on the low side and 75 on the high side. And so the midpoint, 50, would be kind of no man's land. So let's just say the options right now are trading for 65 vol. Well, that's on the upper end. So you know that the volatility or the option prices are expensive. Now, in theory, that those option prices, when they're high, they should revert back to their mean. And when they're, really low, they should actually tend to go higher. Now, is that always going to be the case? No. There's an old saying in the market that the market can stay irrational longer than you can stay liquid. So just because an option is expensive and you sell it, there's no guarantee that you're going to make money. Just because you buy an option that's cheap doesn't necessarily mean you're going to be profitable. Over time, in theory, you should be profitable, but sometimes the market doesn't cooperate. So why be concerned about implied volatility? Well, it's always going to directly affect your options position, and it's not predictable. So if you can't figure out, if you have this options position on and you can't figure out why you're making money or why you're losing money, invariably the answer lies in changes in implied volatility. If all of a sudden I'm long a straddle, I'm long the 50 call and the 50 put, and I paid $3 for it, and I wake up tomorrow morning and the stock's in the same place, and now it's trading for $3.75. And I'm thinking, wow, that's great, but what just happened? What happened was implied volatility went through the roof, probably. Okay, there's more demand for those options, and those options that you paid $3 for yesterday are now trading for $3.75. So once again, if you can't figure out why you're making or losing money on a particular position, probably the most likely reason lies with a change in implied volatility. So implied volatility's effect on option prices. So a change in an underlying historical volatility may or may not affect an option's price. Okay, so if a stock has been volatile in the past, yeah, maybe the implied volatility might be high because of that, but not necessarily. But if implied volatility goes higher, it's going to affect both call and put prices. So if vol goes high, call and put prices will increase. And as implied volatility decreases, both call and put prices will decrease. So if now, I'm not going to talk about Vega, but my colleague Matt Cashman will actually be presenting next month. He'll be doing an extensive webinar on the Greeks. So if you're new to options or want to learn more about the Greeks, which I certainly encourage you all to do if you don't understand the Greeks, to watch that webinar. But there's a Greek, one of the Greeks is known as Vega. So anytime you have an options position, you're going to have a Greek position. You're going to have a delta, a gamma, a vega, a theta, and a rho. And Vega is your option sensitivity to changes in implied volatility. So if you own options and volatility goes up, you're going to benefit from that. That's going to benefit you because your option position is going to be worth more. If you're long options and implied volatility goes low, that's going to hurt you. Just like if you're short options and implied volatility goes higher, that's going to hurt you. And if you're short options and implied volatility goes lower, that's going to help you. All right, so now volatility. What is a? Let's look at an example here. So we have a stock that's trading $80, and the 1-year options are trading at a 30% implied volatility. So what exactly does that mean? Okay, well, what that means is, since volatility is an annualized number, what it means is that over the next year, the options are implying that over the next year that this stock will be up or down by 30%. Okay, so 30% of 80 is 24. So looking at the table here, and based on statistics, if you took 24 from 80, that's 56, and you add 24 to 80, that's 104. So based on a vol of 30, this means that the stock will be trading between 56 and 104. That's one standard deviation, 68% of the time. So if there's a probability of it trading between 56 and 104, 68% of the time, then naturally there's got to be a 32% probability that it falls outside that range, because the probabilities have to add up to 100. And option traders are always using probability and trying to figure out, what's a good sale and what's a good buy, and using probability to determine which are the best strategies they want to deploy. Now, for a 2 standard deviation move, you simply double the amount of the move here, in this case, from 24 to 48. So a 2 standard deviation move would equate to the stock trading between 32 and 128. And a 2 standard deviation move equates to a 95% probability. And if it's a 95% probability that it's going to trade within that range, there's a 5% probability that it'll trade outside that range. Now, for a 3 standard deviation move, which is called a 3 sigma move, okay, the range would be $8 and 152. So we would expect at a 30 vol that this stock over the next year will trade between $8 and 152, 99% of the time, and 1% of the time it'll trade outside that range. So now this is for an annualized number. So volatility is a function of the square root of time and not time directly. So what does this mean if I'm trading an option that's about a week out? So I think I know this last year was a particularly, we had a record volume year for options, and I think reading one of the statistics that something like 46% of the volume was near-term options. So a lot of traders are using near-term options. So if I'm buying a near-term option and it's got a 30 vol, that doesn't mean that, in the next week, the stock is going to be up or down by 30%, okay? That 30% is an annualized number. So to convert that, you have to convert that back into a shorter dated time frame. So there's something called the rule of 16, and it's actually really useful. So once again, volatility is a function of the square root of time. So how many trading days are there in a year? Okay, well, there's roughly 252 trading days in a year. So if you square that, that gets you to 16. So if you take your implied volatility, okay, 30, and convert it to a percentage, so 0.30, and you divide it by 16, you multiply that by your stock price, that'll give you your expected one-day move. Now, I went ahead and did all the math. So if you take 0.30, divide by 16, multiply by the stock price 80, that gets you to $1.50. So based on a 30 volatility, we would expect this stock to be up or down by $1.50, 68% of the time on a daily basis. So that's one way. That's another way. That rule of 16 is a good way to measure your one-day expected move for any volatility that you are looking at, or for any option that you're looking at. All right, so now let's look at the moneyness of options. okay? So calls can be, options can be either in the money, at the money, or out of the money. So when we're looking at calls, let's just say the stock is trading $50. So we have all kinds of different strikes here, different months, 40s, 45s, 50s, 55s, and 60s. So when we're looking at calls would be considered in the money if the strike price is below the stock price. So just looking here, stock's at 50, and we look at a Jan 40 call, okay? Well, a Jan 40 call is the right to buy stock at 40 when it's really trading at 50. Well, who would want to do that, okay? Well, the catch is that this option is probably going to be trading for $10 or more, okay? So this option is in the money by $10, okay? So this option we would say is in the money by $10. So that option might be trading for $10.50, okay? So $10 of that premium is intrinsic value, or in the money by $10, and 50 cents would be extrinsic value or time premium. So we'll get into that in a bit, but just wanted to point that out. Now, at the money and out of the money options, so if the stock is trading for 50, we have Jan 50, Feb 50, and April 50 calls. Those would be considered at the money. And at the money options are comprised of all time premium, extrinsic value. They are not in the money whatsoever. And the price that you see is comprised of nothing but time premium. Same with out of the money options. If the strike price for calls is above the stock price, those options would be considered out of the money. So, with the stock trading 50, the April 60 calls, it's the right to buy stock at 60 with the stock trading 50. Well, obviously those options aren't going to be trading for very much because they're $10 out of the money. But if all of a sudden the stock made a $10 move really quickly, those options, in theory, should explode in value. They could be worth a lot. So, they're not going to be trading for very much while they're $10 out of the money. But, if the stock does make a big move in your direction, you could be rewarded for that. So now on the flip side, puts work just the opposite. If the stock is trading for 50, a put would be considered in the money if the strike price is above the stock price. So, with the stock trading 50, if I buy an April 60 put, it's the right to sell shares at 60 even though the stock's trading 50. So that put would be $10 in the money. And it's probably trading for $10 plus, maybe $11, depending on what month it is. But that option would be considered in the money. Likewise, options that are at the strike price, where the stock is, options that have strikes that are at the actual stock price would be considered at the money. And puts would be considered out of the money if the strike price is below the stock price. Okay, so now let's talk about options premium. So option premium. So options can be comprised of both intrinsic value and time value, but only in the money options have intrinsic value, okay? So the intrinsic value is the in the money amount. Time value or extrinsic value is any premium in excess of intrinsic value. So as we saw, in the money options have intrinsic value and extrinsic value, a little time premium. At the money options have all time premium, all extrinsic value. And it's the time premium in the options which decay over time. Remember, an option is, it has a finite life. And every day that we get closer and closer to expiration, that option decays a little bit in value every single day. Now, intrinsic value doesn't decay. It's the time value which decays. Okay, that's so if all of a sudden I buy a 50 call and the stock's trading 50 and there's 3 months to go, and then fast forward 5 weeks and the stock's still at 50, well, that option is probably going to be trading for $1 or something. Okay, I've lost $4 in time value, the time premium, because the stock has done nothing. Okay, but just know that it's the time value, the extrinsic value, which decays. Now, Matt Cashman, as I mentioned, talking about the Greeks, he will be getting into theta, which is your option sensitivity to changes in time during the Greeks webinar. But I just wanted to point that out. It's the time value that decays. So at expiration, what's an option worth? Well, it's only worth its intrinsic value. So when exercised, only the intrinsic value of the option is either received or delivered. Any time value in that option is lost. So this is another, just a chart of what we were just talking about once again. And sometimes it's better, it's easier to visualize this, but an option premium. So options that are in the money, both in the money, calls or puts. If a call has a strike below the stock price, it's going to be in the money, and if it's a put and the strike is above the stock price, it's going to be in the money. So that would be intrinsic value. Now, extrinsic value is comprised of time value. That time value is the time to expiration and the option's volatility. So obviously, the longer dated options are going to cost more because you're paying for time. And, if implied volatility all of a sudden goes up, that's going to increase the option's time value as well. Or if implied volatility goes lower, that's going to decrease an option's time value. So time value is made up of time and volatility. And also contributing to time value is interest rates and or dividends. So just another visual representation here. In the money, calls and puts have both intrinsic value and time value out of their total premium. At the money options have no intrinsic value and all time value. And out of the money options have no intrinsic value and all time value. So, people who like to sell options are usually people who are selling options are trying to take advantage of that theta or time decay. So they'll target at the money or out of the money options in order to try and target that time value, because it's that time value which decreases over time. So if you sell options and the stock is quiet, it doesn't do much, and implied volatility doesn't change, you're going to benefit from that theta or time value eroding those options. All right, so let's in finishing here, let's do a little premium quiz. So now, just grab a piece of scratch paper and write the answers down separately. Don't put your answers down in the Q&A box, because Matt is doing is answering questions in that box, and it'll just flood our Q&A box with answers. But just pull out a piece of scratch paper and try and follow along. So in the first example here, we have a stock that's trading 77, and we have an option. We have the $70 call, and it's trading for $10.50. So based on this, would you think that this option, this 70 call, is in the money, at the money, or out of the money, based on what we talked about? Well, you know that the stock is trading 77, and the call strike is below the stock price, so we know that that option has to be in the money. So now if it's in the money, it has both intrinsic and extrinsic value. So if the stock is trading for $10.50, how much intrinsic value does it have? In other words, how much in the money is this option? Well, if the stock is trading 77 and you own the 70 call, the difference, 77 minus 70, would be $7. So we know that that option, $7 of that option's premium is intrinsic value. Now, intuitively, if that option is trading for $10.50 and it has $7 of the intrinsic value, what would be its time value? Well, you simply take the option's price, $10.50, minus the intrinsic value of 7, and bam, that gets you to $3.50. So obviously, if you add the intrinsic value plus the time value, that's going to give you the total amount of the premium for this in-the-money option. All right, so now let's look at a put example. So we have a stock price that's trading $58.50, and we're going to look at the 60 put that's trading $3.75. Now, with this example, would you consider the option to be in the money, at the money, or out of the money? Give you a chance to think about it. So in the case of puts, because the strike of the put is above the stock price, this option would naturally be in the money, okay? So if it's in the money, it's going to have both intrinsic value plus time value. So how much intrinsic value does this option have? Okay, well, 60 minus 58.50, that's going to give you $1.50. So if you wrote down $1.50, give yourself an A. So if it's got $1.50 of intrinsic value, how much time value is left in the option? Well, naturally, if the option is trading for $3.75, and we know that it has $1.50 of an intrinsic value, we simply take $3.75 minus $1.50, 2.25. So if you wrote down 2.25, give yourself an A. So as you can see, two components of both in both examples, both intrinsic value and time premium. And remember, it's the time premium is what decays over time, not the intrinsic value. All right, so now we have a stock. We have a stock that's trading 83, and we're looking at the 85 call. Now, would you consider this option in the money, at the money, or out of the money? So think about it. So because the call price is above the stock price, okay, this option would naturally be out of the money, okay? So when we see it's trading for 2.25, how much of that option's value is intrinsic value? What do you think? Well, naturally, if it's out of the money, it wouldn't have intrinsic value. So the intrinsic value would be 0. And so if the intrinsic value is 0 and the premium is 2.25, we know that that entire premium, 225, is extrinsic value or time value. In the last example here, if a stock is trading $12.50 and we're looking at the $12.50 call and it's trading for $1.50, would you consider this option to be in the money, at the money, or out of the money? Okay, so remember that the stock is trading right at strike. Okay, so in this case, the option's price, it wouldn't be in the money, it wouldn't be out of the money. So if it's not in the money or out of the money, it would be considered at the money. And we know from what I talked about earlier, at the money options don't have intrinsic value. So if this is an at the money option, it would have 0 intrinsic value. And lastly, how much of that premium, the $1.50 that we're looking at, is extrinsic value or time premium? Well, if it has no intrinsic value, we know that the premium, all that premium, the $1.50, is all extrinsic value. All right. So I hope you did well on that quiz. And, certainly that is the end of our presentation. I appreciate everyone taking the time today to attend. For more information on this subject, you can certainly reach out to us at optionseducation.org for continuing education. If you have any questions related to options, you can reach out to us at options@theocc.com with any and all of your options-related questions. And certainly check out our YouTube channel where we have archived many of our past webinar presentations. So if there's a subject you want to study more about, whether it's implied volatility, whether it is, condors, butterflies, corporate actions, we have done multiple videos on just about any subject that you can think of. So once again, this is a free service and a great resource to use. So with that, I know Matt's been answering. We do have a little time left over. I know Matt's been answering a lot of questions along the way. So maybe we'll set aside and see what we can do looking at some of the questions. Let's see. All right, so somebody's asking, what is the advantage or disadvantage of European-style options versus American-style options? Well, European style options, once again, they usually cover the big indexes, the SPX, the Russell, the NDX, things like that. They are cash settled indexes, so they don't require the physical delivery of stock. They are settled in cash, and there's no early exercise. You can't exercise a European option early. Now, and obviously you wouldn't want to because it's cash settled. There's no incentive to exercise early. Now, for an American style option, they can be exercised early. And why would somebody want to exercise an American style option early? Okay, well, once again, for somebody to exercise an option early, there has to be an economic incentive for them to do so. Because anybody who exercises an option early would be foregoing any time premium left in that option. So the most, popular reason why somebody might exercise an option early, especially a call option, is in the case of a dividend. So let's just say you have a deep in the money, you're short a deep in the money option, and it's a 40 call, the stock's trading 50, and they're trading for 10 and a quarter. So that option has 25 cents of $10 of intrinsic value and 25 cents of time premium. But let's just say the dividend that they're going to pay is 75 cents. If the time premium or extrinsic value of that option is less than the dividend that's about to be paid, that option is a strong candidate to be exercised early for the dividend. So if you're somebody who likes to do covered calls and you're short options that are deep in the money, but you got a dividend coming up, this is something you're going to want to monitor, because if the option falls under that category where the time premium is less than the dividend, and you don't buy it back or roll it or do something, you could very well be assigned on that stock where you wouldn't get the dividend. Your stock would be called away. You wake up in the morning with a bunch of cash in your account, but you wouldn't get the dividend. And why would somebody exercise a put early? Well, it doesn't really happen that often now, but when interest rates were a lot higher, somebody might exercise a put early if the short interest to be gained on selling the shares is greater than the time premium left in the option. So, in the 90s when interest rates were a lot higher, deep in the money puts, sometimes you would see those get exercised early for the short interest. But nowadays, with interest rates practically zero, the likelihood of somebody exercising early for short interest is not that common. Let's see. All right, so somebody else asked, what does the put-call ratio really tell you, that there are sellers and buyers for each contract? It's a higher put-call ratio similar to high IV. Well, yeah, it's a put-call ratio is simply the ratio of puts to calls that are trading. And obviously, if there's more puts than calls that are trading, okay, that's, somewhat, some people will use it as a contrary indicator. So in other words, if all of a sudden there's a preponderance of puts being traded, people are reaching for protection, they're scared, they think the market's going to make a big move down, sometimes that it's a prelude to the market taking a bounce. Sometimes this can be a contrary indicator. So, some people will use the put-call ratio in that sense and use it as a contrary indicator. Just like some people will use the VIX. The VIX, I don't know if many of you watch the VIX. The VIX simply is a measure of the implied volatility, the 30-day implied volatility on the S&P 500 options. So when you pull up the VIX on your screen, and I think today it was about 20, basically what that's telling you is the level of the implied volatility, the 30-day implied volatility on the S&P 500 options. So when the VIX goes higher, it's indicating that the options on the S&P 500 are getting more expensive and traders are getting nervous. And when the VIX goes lower, it's implying that the options are getting cheaper and the market's getting a little more complacent. So sometimes when the VIX is really low, people will use that as a contrary indicator to indicate, well, maybe the market's overbought or is ready for a down move. Doesn't necessarily mean it's always going to happen, but a low VIX could be an indicator if the market might be ready. The market might be a little more too complacent right now and could be set up for a sell-off. Just like a high VIX, when the market is selling off high, and the VIX is exploding and the options prices are going through the roof, and everybody's, freaking out, that might be an indicator that we're at a near-term bottom. Okay, so sometimes people use these as contrary indicators. So, so I know we're right at 4:30. So I know that there's some other questions that are in the inbox. Just know that if for whatever reason we didn't get to one of your questions today, somebody on our investor services team will reach out to you in the next 24 hours with an answer to your question. So all questions do get answered. And I just want to thank everybody once again for attending today. And we look forward to seeing you in March, where Matt Cashman will be presenting his webinar on the Greeks. You won't want to miss that. So with that, I'm going to say good night. Thank you for attending, and stay safe, everyone.